Hey, what's happening, guys? Dan Darrow here with another Options in Play video update. So we are, as of this video, currently up a ton, and we came into today up, right? Things started positive, and it's built throughout the day. Most notably, though, after Powell's statement right around noon. So, um, staring at a pretty big day across the board. And what may have jump started it all is Salesforce, and that's what this video is going to talk about. It's Salesforce, the stock, and also the option strategy, which we took into earnings last night. Um, so Salesforce, market cap wise, definitely the biggest name, and really important for like the overall state of tech because it's one of the biggest software stocks, next to say like a Microsoft and an Oracle. Uh, and what you got last night was a pretty solid number, right? So Salesforce beat. Let's zoom in a little bit here. So Salesforce beat top and bottom, had pretty solid guidance, and coming into the week, I I really tried to keep an open mind, right? Because the issue with Salesforce and a lot of similar tech setups was that uh, the overall risk off environment prevented a lot of good action. So it's not as if the numbers had been specifically bad. I mean, there had been some companies that missed, or some companies that took down guidance, but uh, what you had been seeing was some decent numbers that just had pretty bad reactions because it was just risk off. People wanted out, and there were times when it really didn't matter what they said. It's good or bad, the thing was going down. So I I wanted to use Salesforce as kind of like a barometer, see what the like the risk tolerances in the market, and um, you know obviously it's showing you. I mean, the market's up quite a bit today because of the Powell statement, but Salesforce was up um, handily even before that. And I thought it was an interesting setup just because the stock had gotten knocked down sharply. Uh, Earnings the last few quarters, just beat and raise, beat and raise, beat and raise. So, the stock was well off the high. Expectations had come down maybe a little bit, but the stock has had a really strong history of solid execution. So, you had to be slightly bullish biased, and then, if they did deliver, then it would come down to, how good of a number and what the overall risk appetite was, and obviously you can see that both lined up, right? The number delivered, and traders are more risk on at least today. I mean, we'll see how that lasts. With the G20 and maybe like the Fed meeting later this month. But uh, what I was thinking with on Salesforce was there's a couple things to take into account, right, with the setup. So the options are priced in at about 8.5, which is not it's not crazy. I mean, that's about the top of what Salesforce has moved. But you can see that the volatility was expanding on it, right? I mean, over like the last 2 months, you're seeing more intraday swings, greater magnitude than really it's seen uh, over like the course of like the year, right? So you can see the volatility was expanding. So options were kind of priced according to that, not necessarily what it's done on earnings in the past. And I feel like it created this scenario where options were a little bit more expensive. Things hadn't gotten rewarded. So if you wanted to play to the upside, you needed a way to manage the risk a little bit better, right? Because whether it was going to get rewarded on a bullish print was less clear, right? Because a lot of names haven't been this quarter. So if you wanted to be involved on the long side, you needed a strategy that allowed you to play it with lower risk, right? Manage like the implied volatility of the options a little bit better, and that's why call fly was interesting, right? There's certain ways to do it. Spreads are one. flies, so call fly in this case, maybe even like a calendar spread or a little bit different strategy. I mean, like those are the three that I normally look at. If I'm trying to, if I think options are a little bit more expensive, I want something closer to the money, and I want to manage risk more. So why I thought the fly was interesting was because you have some interesting or well defined levels, right? So just quickly draw a few things here. So it's kind of stalled out a couple times right around 140, right? So you can see that it popped up close to it today. And 130 recently had been, so it had like basically a double bottom at 130 until it really broke, and then that's when it flushed out. So what you had was you had pretty well defined resistance up top around 140, support around 130, and then what's even more interesting was right kind of smack in the middle is the 200-day, right? So it kind of cruised through the 200-day bounce, cruised through it again, but you figure that a stock that's coming off, last week it got down to 113, so a stock that's coming off like 20, 30 points off the bottom, that it would probably find some resistance at the 200-day on the way back up, at least on the first go at it, and then even if it did clear that, you're probably thinking that 140, which had been resistance a couple times this year, you're figuring that like that's considering like the magnitude of the rally, that like either of those levels would probably be resistance on the first pop if the numbers are good and the stock gapped up, right? So what that did was it created a nice little range to work with, and the fly that we went with was 130, 135, 140 fly for next week. And like the way that is designed is basically that 135, aka the 200-day, is the high watermark of that strategy. So if Salesforce closed at 135 next week, then that would be like the max reward potential for that position, right? And the reason 135 was selected was because of that 200-day. You have like a really obvious moving average right smack in the middle of a decent 10-point wide range. And today it's been kind of it opened up, came back below, back up. But what you have to like realize with flies is that time and implied volatility are kind of like the key. So if it moves in a favor, which Salesforce has done at this point, right? What happens is the contract or the position in this case won't be max gain. So the fact that it's maybe worth if it's 137.50, say, like it should be worth 2.5, but it's not going to be at that price point because of the middle, so like the short calls, so like the short 135s, because you have two of them, the implied volatility is going to be still a little bit higher. So that's why when you do like these flies, there's kind of like two areas to exit. So it's either you get out early and take like the more marginal gain if it moves in your favor, right? So in this case, if it pops, like the position will be up, but it's not going to be anywhere near max because there's still time left, and the options are still trading at a higher implied volatility because the stock is up 10 points today, and with the range and the volatility and the volume expanding, I mean the options are still pretty bid up. So you can either exit early and take like the smaller gain, or you could hold on closer to expiration, and if the stock comes back and settles into a range around 135, then you should see the implied volatility start to contract across the board on those options, but that mainly benefits the short 135s because at the moment those are the ones trading at the highest premium, right? Because they're at the money options are they're trading with some time value and also some intrinsic value, right? Versus the 130s are more deep in the money and they're basically intrinsic value, and the 140s are still out of the money, so it's kind of only like small time value. So basically, you either have to get out early and take the money and run, or you have to hold on and wait for the implied volatility and the premiums to contract, and then you might get something closer to the intrinsic value of the position or where it's trading at then. So with Salesforce, the contracts went out through. Let's pull up the spread. So the contracts went out through next week, the 7th, and just I just wanted to like highlight basically what you're looking at is the implied volatility on the options are still elevated, as you can see, right? So still trading above historical, and that's because it's the day of earnings, the stock is up a ton, so you can either close out early or you wait and you need to see this start to contract, and this is key because this is like the middle of the spread. I mean, you want to see this start to contract because right now like that's really what's preventing like the position from getting more close to what the intrinsic value is. So that's what we'll be watching. But like really what I wanted to highlight was why flies are interesting, right? Because you can manage the risk of more expensive options, right? And if you have like some good levels to work with, then it's not like some people say that flies are like throwing darts at a board trying to pick the range. But if you have really quality levels to work with, then it's not. Because you could see 140, you could see the 200A, and then 130 here. So the levels uh, kind of presented themselves, right? And then it was just designing a strategy to try to capitalize on a move back into like this trading range that it's been in for the last couple months. So I hope this was a helpful video. You know, call flies, all sorts of flies. So like put flies also, they're a little bit more complex option strategy, and I know people typically have questions. Getting in, getting out. What's the target? How do you manage it? So, these are always positions that bring up a lot of questions. So I feel like it's good to like spend time going over it. But yeah, as always, if you have questions or comments, please reach out. I'd love to hear from you. If you pass something along, I can address it in a video, and then it works for everybody. So have a great night, and I'll talk to you guys tomorrow.